Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So recently I have been getting questions regarding the semiconductor companies. As we know, they went up so much in the last 12 months, and then recently they have had a bit of a decline. So some of them have come back quite a bit, about 10% or more. So I've been getting questions regarding whether it's now time to buy them or not. So what I'm going to do is I'm going to basically look at 5 out of the semiconductor companies out there, and we will look at the valuations from Morningstar, and then we will also look at Seeking Alpha valuations, what the analysts are saying, as well as of course the projections for, or the estimates for earnings per share, as well as the revenue, which is quite important moving forward, inshallah. Now, if you like this type of content, you are enjoying the channel, you are enjoying, the seeing actual portfolio, this is a real money, okay, you like the transparency, I just ask you just to do 2 things. If you can like and subscribe to the channel, that will be really helpful, because there are about 45% of you that watch the videos regularly but have not subscribed yet, so that will be really helpful. And of course, if you can help us, you can join us at the Patreon account. You can support the channel and get access to all of these things. You can also get access to a bit more if you all, of course, join us on the elite section. This is the most popular tier of the 2. You've got a lot of access to a lot of things, including the Discord, where a lot of brothers and sisters are sharing good practices. So that will be really helpful if you can do that. Now, what I'm going to do first is just to kind of give you an overview of where we are. So a year to date, basically, we are up so much, okay? If you look at these companies, basically these indices, for example, the S&P 500 is up about 15%, the Dow Jones about 7%, and the Nasdaq 14%, 15% almost. The FTSE is doing well as well, 7.3%. Now, one thing I'm going to do now is find out SHMH, which is the ETF that tracks the semis, okay? Now, look at this, 42% up basically for the last, basically since the year to date. So since beginning of January up until now, it's up 42%. But they have come down quite a bit in the last few weeks. So if we look at, for example, for the 1 month, okay, you can see the semis have come down about 8%, whereas the rest of remember, the Nasdaq is full of semiconductor companies, so that's probably why. So as you can see, they have come down a little bit. So we want to see now if any of these companies are actually a good buy right now, or if we should avoid it. We are looking for exactly the same things that we're looking for. So the valuation is the most important part, but at the same time, I'm going to share the rest of the information with you guys, so at least you have an idea of what these companies are doing financially. So 350 billion market cap right now, that's ASML. ASML sells the equipment that is used, okay, the machinery, the whole, without ASML, there will be no semiconductors. Taiwan Semiconductor will not be able to create, or Intel's or whatever, Samsung's will not be able to produce the product that they produce without the machinery this company creates. And these machineries, believe me or not, cost about 100 million plus. Some of them even cost up excess of 400 million, which per unit, per thing, right? So it has a wide economic moat. $888 per share right now. Dividend yield it's not a lot, but it is something there. You get $6.65. okay, safety is 82%. Of course, the growth side of it is really good, okay. In terms of profit, in terms of the 5-year growth rate revenue side of it, as you can see, it's about 20% and 28% when it comes to the EPS. Profit margin about 26%, return on equity of 53%. Now, return on invested capital 40%. So this company is doing absolutely amazing job, and the management should be, they're doing an absolutely amazing job in terms of increasing revenue, increasing EPS, the profit margin side of things, the reinvesting the money that we've given them, and of course doing something important with that, and the fact that they have a $3.6 billion of free cash flow. Now, total return in the last 10 years, we're looking about 27% per annum, which is absolutely huge. Now, they're expecting the earnings to grow by over 59% this year. Next year, about 22%. Is fairly valued right now. $990 per share is where a Morningstar thinks this company should be. This is very interesting. Right, let's now have a look at what Wall Street is saying. So there are 25 strong buys, 5 buys, 8 holds, and 1 strong sell. Now 29% upside from where we are. $1,146 per share is where they think the price should be. In terms of looking at earnings side of things, if we look at the estimates moving forward, as you can see, we're expecting a bit of a decline this year of over 5%, but the following year 58%, then 15%, 22%, and then so on. So on average, that's why what you see here is the average basically from that basically. Okay, so it's an interesting company, and it looks like it's actually under, fairly valued at the moment. But look at the forward PE. If you're following forward PEs and you're looking at that, it is quite expensive. But a lot of investors are paying higher multiples because of the growth side of this business. Now let's have a look at the next one. And then that one is no surprise, is Broadcom. Broadcom has been one of my best investments since I've started this whole journey, right? Right now is basically over 700 market cap. That's absolutely huge. Okay, they have a wide economic more, $151 per share. They did split, so that's probably why you're thinking what the heck is going on here. So I do own it. I'll share with you guys in a second. But as you can see here, dividend yield of 1.4. Trust me, at one point when I was investing in this company, the yield was over 3%, about 3%. That tells us it's gone up so much since then. The payout ratio is only 47%, so they have room to increase that. Latest increase was 14%, the 5-year growth rate of 29%, and dividend streak of 5 years. The annual payout right now is $2.10. It used to be about 21, I think, or so per share. But now, of course, because of the split, safety $67 per share in terms of safety 67% in terms of safety, dividend safety, that is. The 5-year revenue growth rate basically right now is about 14% in the last 5 years, 22% in terms of EPS, profit margin 24%, return on equity about 22%, return on invested capital about 10%, $11 billion of free cash flow. Right now, this company acquires a lot of other businesses. So over the years, they bought so many different companies. And that's why when you look at their business, especially VMware recently, so they're now in the software side of things, as well as the network, as well as basically the semi side of things. Total return the last 10 years, we're looking about 37%, which is absolutely huge. 20% expected to grow about 27% this year or next year, and then following 5 years about 18%, which is absolutely huge. Fairly valued as well, $155 per share, is $151 right now as we speak. Now, as you can see, Wall Street is saying it's actually strong buy, so let's have a look. 27 strong buys, 9 buys, 5 holds. And when we look at their price expectation, it's 27% upside from where we are right now, $192 per share. Now, earnings expectations, let's show you 12%, 27%, 26%, 16%, 22%, and then so on. Now, if you focus again, the first three, 43%, 16%, 11%, 43%, 44%. That's probably a lot to do with VMware. I think VMware is already part of their revenue side of it, but I think for yearly, let me in fact just have a look at the quarterly, see what that looks like. Okay, still huge. So anyway, the moral of the story is growing massively, which is really nice to see. And right now it looks like it's fairly valued. I'll tell you exactly what I will be doing with all 3 of these companies that I own in, that we're going to talk about today. I do own all 3 here. Qualcomm is the next one, 201 billion market cap, narrow economic more, $180 per share right now as we speak. This company also used to be one of the companies where I was down so much, but right now it's up so much, it's ridiculous, even though I took some profit off the table as well. Almost 2% when it comes to dividend yield. Dividend payout right now is about 35%. Latest increase of 6%, and the 5-year growth rate of 5%. I would like this to be about 7% or so, but it's fine for now. Dividend streak for 20 years, annual payouts for $3.40. Safety 80%, 11% when it comes to the revenue side of it into the last 5 years. EPS 31%, profit margin 23%, return on equity of 38%, and return on invested capital of 23%. Now $12 billion of free cash flow right now. Total return the last 10 years, we're looking about 10%. Growth estimate next year 14%, 11% after that. For every single year per annum, you're expecting the earnings to grow by 11%. Fairly value right now, $180 per share. $180 per share is exactly where it is. At the end of the video, I'm going to compare all of them and I'll show you if they actually beat the S&P 500 over the last 5 to 10 years. If you have not liked the video already, please do so. It really massively helps the channel. Now, let's have a look at the Wall Street. 14 strong buys, 7 buys, 13 holds, 1 sell and 1 strong sell. Now in terms of basically price wise, 19% upside from where we are. $214 per share is where they think the price should be, and right now is $180 per share. Expectations when it comes to earnings side of things, so we're looking about double digits every single year for the next 3 years. Things have changed. I remember there when this used to be a negative, and right now 7%, 10%, another 7% when it comes to revenue. I really like this business. It's a great company. It's been one of my favorite companies, and I'll share it with you guys in a second what I will do moving forward. Now, next one is Texas Instrument, another company that's been up so much since the beginning of the year. 184 billion market cap, wide economic moat, $201 per share right now. Dividend yield of 2.5%, which is really good. The yield is really nice. The payout ratio 90%, which is crazy. Okay, that needs to come down a lot. Latest increase of only 5%. The 14% in terms of the last 5 years, which is absolutely wonderful to see. 20 years of increase in it. So they will become a dividend king, a dividend aristocrat very soon. Annual payout $5.20. Safety 80%. Latest increase was only 3%. Sorry, the revenue grew about 3%. The EPS about 5%, which I'm very surprised about. But profit margin 32%, return on equity 31%, and 19% when it comes to return on invested capital. $1.5 billion of free cash flow, 17% in terms of total return in the last 10 years, 25% growth estimate next year, then about minus 3% premium right now, about 38%, $146 per share is where the price should be. This is let's find out what Wall Street is saying about the company. As you can see, it's all hold. So let's see, 9 strong buys, 2 buys, 18 hold, 3 sells and 3 strong sells, and right now it's flat when it comes to 202. Right now it's 202 almost. So estimate for moving forward negative 24%, but then the years after that, okay, it bounces back. Okay, so and anything can happen. It can easily change. I remember at one point Qualcomm was at this similar situation. The following year the AI situation happened and the company basically completely changed. Now as you can see, double digits every single year following basically 2025, 2027, but next year it's not going well according to these analysts. Final company we're going to talk about today is Tower Semi. We've talked about this recently. 774 billion market cap, wide economic moat, one of the best companies. Between these two companies, they are the best when it comes to semis. I will say they may have monopolized the markets. Of course, there are other companies that are very similar, like Samsung and so on, but they are absolutely wonderful businesses. Now, dividend yield, I don't worry about this company when it comes. They do pay dividends, but they don't really care. They just don't consistently increase every single year. But for the last 5 years, we're looking at about 10%, which is really nice. In terms of EPS growth, we're looking at about 16%, and revenue about 17%. Profit margin 37, 26% when it comes to return on equity, 21% when it comes to return on invested capital, and almost $14 billion of free cash flow. Now, in terms of total return the last 10 years, we're looking at about 24%, which is absolutely huge. Look at this. Expected to grow about 26% next year, 22% after that, 24% discounted right now, $213 per share. Like I said in one of the videos, this is one of the companies that is still undervalued, but the issue is we cannot buy. I would buy this today, to be honest with you, if I could buy it through my ISA, but apparently I cannot do that. And now look at this. Wall Street say it is a strong buy. Quants is actually strong buy, and buy from Seeking Alpha analyst. Now 10 buys, 4 buys and 1 hold. That's probably why it's a strong buys. And 28% upside from where we are. $208 per share is where they think the price should be. In here 213, in here 208, which is more or less the same. Now earnings expectations moving forward, we're looking at about 26, 12%, and then 24%, 24%, 30, 17%. Very nice company. Now final thing I want to show you guys is this. Okay, so we're going to compare. We're looking at the total returns of the last 10 years for all the companies. And as you can see here, this is the S&P 500, so 183% in comparison to what Qualcomm has done, 235, ASML 957, Texas Instrument 474, TSMC 951, 2,688% total return in the last 10 years for this company is absolutely ridiculous. Absolutely ridiculous. So there you have it. They are really good business. That this, by the way, does not tell us what is going to happen in the future, but it gives us at least an idea. And the fact that all these analysts actually saying they are, majority of them anyway, are right now, okay, that fair value, then it's a good thing. Okay, now what would I do if I had this stock? Right, ASML, right now I'm not touching it. It's too expensive for me because I do own it, and I bought it when it was about $600 per share. So I do have other companies that are undervalued at the moment, so I'd rather focus on them than actually putting more money into this company for now. Same goes for Broadcom. I'm up over 200%, £4,000 profit right now. It's absolutely ridiculous. And the fact that when they did the split, now I feel like I own more now of the company, but it's exactly the same, 550 shares right now. The next one is Qualcomm as well. They're similar situation, up 43%, 1,000 almost £300 up since I bought the company. So I'm gonna leave them alone for now. If there is a massive market dip, then potentially I will look into them, but right now I'm just gonna leave them alone. And final thing I want to show you is this. Okay, pause the video and of course you can have a quick look. But one thing I want to say is before we finish, this takes a lot of time to put together. I would genuinely appreciate if you're still here, like the video, subscribe to the channel, let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.